As the summer winds down, investors are left grappling with a pressing question. What lies ahead for the markets as we approach year-end? But here's where it gets intriguing. Amidst a slowing labor market, lingering tariff uncertainties, and a stock market that seems to defy gravity, Goldman Sachs has stepped in with a strategic playbook. And this is the part most people miss. It's not just about surviving the volatility, but positioning yourself to thrive. In a September 5th note, Goldman Sachs outlined 3 key themes for U.S. equities through the end of 2025, each offering a unique opportunity for savvy investors. First on their list, alternative asset management stocks. Goldman's analysts, led by David Kostin, argue that these companies are undervalued compared to their banking counterparts, whose valuations soared post-election. Unlike banks, alternative asset managers haven't fully recovered, making them a potentially lucrative play. Kostin highlights that these stocks could benefit from a surge in capital markets activity, broader economic growth, and the optimism surrounding financial deregulation. For instance, equity issuance is up 23% year over year, signaling a bullish environment for these firms. But here's where it gets controversial. Goldman's second recommendation focuses on companies with high levels of floating rate debt. While this might sound risky, the analysts argue that impending interest rate cuts could ease balance sheet pressures and boost profitability. Since August, a basket of such stocks, GSX UIFL, has already rallied by 13%, aligning with the Federal Reserve's dovish stance. Additionally, the One Big Beautiful Bill Act, which allows for greater interest deductions on taxes, could further sweeten the deal for these companies. Finally, Goldman is bullish on gold mining stocks, citing the commodity's impressive 37% year-to-date gain and its resilience in recent months. Their commodity strategists predict a 14% rise in gold prices through 2026, driven by strong demand from central banks and ETFs. Interestingly, Goldman analysts draw a parallel between gold's price movements and Manhattan real estate, rather than commodities like oil, underscoring its unique appeal as a hedge against uncertainty. Here's the thought-provoking question. With these recommendations, is Goldman Sachs offering a roadmap to navigate market volatility, or are they making bold bets that could backfire? Do you agree with their focus on alternative asset managers, floating rate debt companies, and gold miners? Share your thoughts in the comments. We'd love to hear your take on these strategies as we head into the final stretch of the year.